Have you ever felt that that nagging uncertainty when you're looking at your investments?
Hmm.
Or perhaps you're just wondering if there's more out there beyond the familiar territory, you know, stocks and bonds.
Yeah, it's a sentiment we hear quite a bit, actually. And for good reason.
Right, that feeling where the market data can just be overwhelming. And you want new ways to grow your wealth, but maybe you're not quite sure where to start.
Absolutely. The financial landscape is shifting. It really is. And while traditional portfolios, the ones we know well, have served us okay, they're certainly facing some new challenges and opportunities, too.
Exactly. And that's why today we're embarking on a deep dive into alternative investments.
Okay?
Now, before you imagine this is just some like obscure financial jargon for Wall Street insiders, let me stop you right there.
Yeah, it sounds intimidating sometimes.
It does. But this is about understanding a really significant and rapidly growing part of the financial world, something many institutional investors, the big players, are already leaning into heavily.
That's right. And our deep dive today, it's powered by a really comprehensive guide to alternatives from JPMorgan. Gives us a very current look at the landscape as of May 31, 2025, or the latest data available.
It's a great resource.
It is. Really helps frame where these markets are right now.
So our mission today is pretty clear.
Yeah.
We're going to unpack what alternatives truly are, how they can strategically fit into traditional portfolios, and really explore the specific trends and opportunities within the key alternative asset classes. We want to help you understand precisely where things stand and, maybe more importantly, why it matters for your investment perspective. Okay, let's unpack this.
Sounds good. And, to really appreciate why alternatives are getting so much attention right now, we probably need to look at the traditional baseline first.
The old standard.
Exactly. The classic 60-40 portfolio, 60% equities, 40% bonds. Historically, this blend, it's been a solid foundation. Average earnings or coupon yield around 6.06%.
Okay.
Now, as of May 31st, 2025, that yield's a bit tighter, around 4.78%.
Which suggests it's currently cheaper relative to its history.
That's one way to look at it, yeah, with an implied return of 5.7%.
Okay. But here's where it gets, I think, really fascinating and maybe a bit unsettling for some traditional investors. That correlation.
Yes, the correlation between the S&P 500 and the U.S. 10-year Treasury. It's really seeing some seismic shifts.
Huge shifts. Historically, say 63 to 99, they tended to move together, right? Positive correlation.
Correct. But then from 2000 to 2020, they actually moved inversely, negative correlation.
Which was great for diversification. Bonds zigged when stocks zagged.
Precisely. Bonds often provided that counterbalance when stocks dipped. But since 2021 through May 2025,
It's flipped back.
it's swung back to a positive correlation. So bonds, for a period, were acting more like stocks than a diversifier.
Especially with higher inflation.
Exactly. Especially in an environment where average inflation has been notably higher, around 5.00%, compared to just 2.13% in that earlier 0-20 period.
So that really challenges the traditional diversification idea, doesn't it? The old playbook might not work quite as well.
It certainly compels investors to seek new ways to genuinely balance their risks.
Right. And that real yield picture
Mm-hmm.
that tells a story too. The 60-40 portfolio's nominal yield minus inflation.
Yeah, the real yield. As of May 31st, 2025, the nominal yield was 2.9%.
Okay.
But core CPI year over year was 2.8%. So the real yield was
Tiny. Just 0.1%.
pretty tight.
So if the 60-40 was the trusty family sedan of investing, maybe it's not quite built for today's economic superhighways. It's really clear why people are looking elsewhere.
Absolutely clear. And that's where alternatives step in.
Okay, define them broadly for us.
Simply put, think of them as anything outside your typical stocks and bonds. Assets designed to offer a different kind of return or a different risk profile.
And their role. What are they supposed to do in a portfolio?
Well, their potential role is multifaceted. They can offer genuine diversification, like we were just discussing. They can potentially enhance returns over the long run and maybe even reduce overall portfolio volatility, things traditional assets alone might struggle with now.
And the data backs this up. I mean, adding alts actually changes the risk-return profile.
It can. For example, the JPMorgan data showed a hypothetical portfolio with 50% equities, 30% bonds, and 20% alternatives. Over the period 1Q98 to 4Q24, it had annualized returns of 9.1% with 8.1% volatility.
Okay, and compared to the 60/40.
The 60/40 over that same period had higher returns, 9.9%, but also slightly lower volatility at 7.3%. So it's not always about boosting returns. Sometimes it's about managing risk or achieving similar returns differently. It depends on the specific alternatives, of course.
Got it. And the growth in this space.
Yeah.
You mentioned it's huge.
Oh, it's staggering. The sheer scale of money moving into alternatives, it's not a whisper, it's a roar.
Give us the numbers.
Global alternative assets under management. They went from about $1.2 trillion in the year 2000 to an eye-watering $19.3 trillion in 2024.
Wow. That's more than a trend. That's a massive shift in strategy.
It really signals where the quote-unquote smart money is heading. We see institutional investors, the largest, often most sophisticated players.
Yeah.
They're allocating a significant chunk, around 81% on average of their portfolios, to alternative.
81%.
And for very high net worth individuals, those with over $30 million, it's an astounding 98%.
Practically all in.
Pretty much. And what's more, looking ahead, over half of institutional investors plan to increase their allocation to alternatives in 2024. Only 6% plan to decrease.
So the momentum is still building.
Definitely. It clearly indicates a broad consensus among the big players. They see these assets as essential for future portfolio construction.
Okay, so let's zoom in then. Let's talk about a really tangible, crucial part of alternatives. Real assets.
Good place to start. We're talking real estate, infrastructure, even things like timber.
Okay, real estate first. Direct investments in property. How do they behave compared to stocks?
Well, historically, direct real estate returns show a negative correlation with the S&P 500. On average, about negative 0.1.
So they move differently.
Exactly, offering that diversification benefit. In fact, in the first quarter of 2025, that correlation was strongly negative, negative 0.8.
That's a key difference from REITs, right? U.S. REITs.
Big difference. Because REITs are publicly traded, they often move more in sync with the broader stock market. Their average correlation is positive, around 0.6.
Got it. And what about inflation? How does direct real estate hold up?
It's historically proven to be a strong inflation hedge. In periods of high or rising inflation, looking back from 4Q78 to 1Q25, direct real estate showed robust returns, somewhere in the range of 7.9% to 10.7%.
That's a really powerful quality for a portfolio, protecting purchasing power.
Absolutely.
Okay, let's look at the U.S. market snapshot now. Using that 1Q25 data, what's the big picture?
Well, the big picture is it's complicated. It's a highly bifurcated market right now, meaning different property types are performing very differently. Overall, transaction volumes across all property types are currently low compared to the peak years.
Okay, activity is down.
And here's an interesting point for investors. Cap rates. That's your expected return based on income.
Right.
They're currently lower, at 5.8%, than what you can get from a relatively risk-free 10-year U.S. Treasury yield, which was 4.3%.
That's unusual, isn't it? Historically, real estate offered a premium for the risk.
Exactly. Historically, average cap rates were 6.9% versus 5.3% for the 10-year. So that inverse relationship we see now means the extra income you're getting for the added risk of owning real estate isn't as compelling as it once was. It tightens the margin.
And property prices reflect this split you mentioned.
Definitely. Year-over-year changes show it clearly. The office sector, for instance, down significantly, over 7% in 1 year.
Ouch.
But in stark contrast, industrial properties are doing quite well, up 6.6%.
So warehouses, logistics centers?
Exactly. And this trend is visible in vacancy rates, too. Industrial has a low 4.0% vacancy, signaling strong demand and high net operating income growth.
Yeah.
Apartments are also relatively healthy, moderate NOI growth.
Well, office.
Office is clearly struggling. A high 14.6% vacancy rate nationally and declining NOI.
Let's dig into that U.S. office market a bit more. It seems like the big challenge.
It faces significant structural challenges. Net absorption, that's the space newly occupied minus space newly vacated.
Yeah.
It's been negative since mid-2020, consistently.
Wow. For years now.
Yes. And this is especially true for older buildings, say pre-1960s and 1960s constructions. They've seen significant cumulative negative net absorption.
But you mentioned bifurcation. It's not all bad.
That's the interesting part. Office vacancy is highly concentrated. About 40% of office assets have almost no vacant space,
Really?
suggesting a very split market. Newer, higher quality spaces, the Class A buildings, are performing much better than older, less desirable ones.
Flight to quality.
Exactly. And we're also seeing new office construction starts at historical lows.
Which could affect future supply, but also shows a lack of confidence right now.
Precisely.
What about the residential side? Anything interesting there?
Well, we've seen the median age of a first-time U.S. homebuyer creep up. It hit 36 years by 2024.
Getting older.
Yeah, and affordability remains a huge hurdle. The existing home price affordability index is quite low.
So it's tough to buy.
Very tough. Meanwhile, those stronger sectors, industrial and multifamily, they continue to show positive net absorption and new deliveries coming online, underscores their strength.
And the retail shift. Online versus physical.
Oh, online retail just continues its relentless march. It now makes up over 20%, almost 21% actually, of total retail sales as of 1Q25.
That's a huge jump from just a few years ago. It was like 10% pre-pandemic.
Right, 10.0% in 1Q19, and some segments are even higher. Clothing is nearly 40% online, electronics over 30%.
And this obviously impacts physical stores.
Undeniably. We've seen significant declines in the number of physical retail establishments, especially for clothing and department discount stores between, say, 2014 and 2024.
But are there any growth areas in physical real estate linked to digital trends?
Absolutely. Data centers.
Ah, the backbone of the cloud.
Exactly. Strong absorption, strong supply growth. Vacancy rates were around 9.9% in 1Q25, which is pretty healthy given the new supply. Demand is just incredibly robust. They are the physical infrastructure for our digital lives.
Makes sense. Let's briefly look globally. Europe and Asia Pacific. Similar trends.
Broadly, yes, with regional variations. European real estate saw transaction volumes decrease significantly in 2023 and into 2024.
So slow down there too.
Yes, but some sectors show resilience. European office prime yields are around 4.9%, with decent rent growth at 6.0%. Industrial yields are similar, 5.0%, slightly lower rent growth.
And APAC.
Similar story with transaction volumes decreasing, but a definite bright spot is multifamily residential in Japan.
You mentioned this earlier, rising rents, high occupancy.
Incredibly high occupancy, nearly 98% in Tokyo and Osaka in late 2024.
Wow. That is tight. Almost makes you wonder if we'll all be moving to Japanese apartments.
Huh. Well, it highlights strong demand, and just as a comparison point on retail space,
Yeah.
North America leads by a huge margin, 600 square feet per person.
Compared to.
Europe at 200 square feet per person, and Asia Pacific at just 100.
That's a massive difference. Really highlights different consumer habits and retail maturity.
It does.
Okay, let's transition now from buildings to, well, bigger stuff. Infrastructure.
Right. Another key part of real assets. Core infrastructure has shown remarkably consistent returns historically.
And income is a big part of that return.
A major component, yes. Think power plants, roads, bridges, pipelines, stable, often long-term cash flows.
What are the biggest segments?
Power is the largest, about 57% of the market, followed by transport at 23%. Together, that's 80%.
And the need for investment here is enormous, right?
Truly massive. Globally, the projected need is $94 trillion between 2016 and 2040.
94 trillion.
With Asia alone representing over half of that need.
And here in the U.S.
We have our own gaps. A projected funding gap of around $0.7 trillion across sectors like roads, power, water over the next decade, 2024, 2033.
And this gap attracts private money.
Absolutely. This substantial need is clearly attracting private capital, looking for those stable, long-term, often inflation-linked returns.
And we're seeing growth in private deals.
We are. An increase in the number of private infrastructure deals globally. Energy is huge here, accounting for 2/3 of deals. Transport is next.
Where are these deals happening mostly?
Europe and North America are leading in terms of deal share.
What about utilities specifically? They're a core part of infrastructure.
Yes, and a key characteristic is that their allowed returns set by regulators tend to correlate with inflation.
So some built-in inflation protection.
Exactly, which is very attractive in the current environment. Utility spending as a percentage of GDP has also been relatively stable over time.
And the energy transition. That must be a huge driver.
Oh, absolutely massive. It's reshaping the whole sector. U.S. electricity generation is clearly shifting.
How so?
We're seeing significant planned additions for solar, around 8.8%, and batteries, 7.6% in 2025 and 2026.
And retirements.
Older coal and natural gas facilities are being retired. It's a clear move towards renewables and storage.
What's driving the demand side of electricity?
Well, two big things. Data centers, like we mentioned,
Right.
and electric vehicles. Data center energy consumption is forecasted to grow substantially. From about 100 terawatt hours in 2024 to maybe 550 by 2030.
That's a five-fold increase.
A huge jump. It will significantly increase their share of total U.S. power demand.
And EVs.
The infrastructure needed is expanding rapidly. EV charging points have increased dramatically, from maybe 15,000 back in 2013 to nearly 200,000 in 2024. That requires huge investment in the grid and charging stations.
Okay, one more under real assets. Timber.
Right, timberland. Often overlooked, but interesting. Returns come from both income, selling timber, and capital appreciation, the land value increasing.
And its inflation characteristic.
What's compelling is its positive correlation with headline CPI. Historically, the R-squared is about 33%.
So it tends to move somewhat in sync with inflation, another potential hedge.
Correct. And its end use is primarily driven by residential construction and home improvements, so it's tied to real economic activity.
Okay, fascinating stuff on real assets. Let's shift gears now to another major area, private capital.
Right. This encompasses private equity, PE, and private credit, PC.
Let's start with PE. There's this interesting trend, fewer public companies.
Yeah, it's quite striking. Historically, the number of listed U.S. companies has actually been declining, while the S&P 500 market cap has soared.
Why is that?
Well, a big reason is that companies are staying private for much longer. The median age at IPO is now over 12 years.
Compared to
An average of less than 9 years, say, from 1991 to 2023.
So a lot more growth is happening before a company goes public.
Exactly. A significant portion of corporate growth and value creation is happening in the private markets. If you're only investing in public stocks, you might be missing out on a huge chunk of that early high-growth phase.
Makes sense. How's a fundraising environment for PE looking?
Global PE fundraising saw some declines recently in 1Q25, particularly for the big buyout funds.
A bit of a slowdown.
A bit, yeah. Fundraising was $46 billion in 1Q25 versus $142 billion a year earlier, but North America remains the largest region for fundraising, showing continued investor interest despite that dip.
Okay, fundraising dip, but what about actual investment activity? Money being put to work.
Interestingly, global PE investment value actually increased in 1Q25. North America saw strong activity, $127 billion invested.
So deploying capital, but what about getting money out?
Exits remain a challenge. They're lower than historical averages, especially in Europe.
Harder to sell companies.
It has been tougher. But interestingly, public listing IPOs became a more significant exit route in 1Q25. It accounted for nearly half of exits.
That's way up from the long-term average of like 14%.
It is. Perhaps a sign of thawing IPO markets, which would be welcome news for PE firms wanting to return capital to their investors.
What sectors are attracting the most PE investment in the U.S. right now?
Looking at 1Q25, business-to-business services and technology were the largest, about 26% and 24% respectively.
Makes sense. Tech disruption, B2B efficiency.
Exactly. That's where private capital sees big opportunities for growth and transformation.
Okay, understanding PE returns. It's not like looking at a stock price, is it? Explain the cash flows.
Right. It's different. Think of a private equity fund, like a long-term project. Initially, there are capital calls.
Money going in.
Yes, negative cash flows as the fund draws money from you, the investor, to make investments. Then, over a typical 10-year, maybe longer investment period, you receive distributions.
Money coming back.
Positive cash flows, hopefully, as the fund successfully sells its investments.
And the key metrics to track this: IRR, MOIC.
Exactly. The internal rate of return, or IRR, is probably the most common. It's like the annualized rate of return, accounting for the timing of those cash flows. A target might be, say, 15% net to investors.
Okay. And MOIC.
Multiple on invested capital. Simpler. Just asks, how many times did I get my initial investment back? So a 1.5x MOIC means you got $1.50 back for every $1 invested.
Got it. And there's also time-weighted return.
Yes, that's more like how mutual fund returns are calculated, ignoring the timing of cash flows. It can look quite different from the IRR, especially early in a fund's life. An illustrative TWR might be much lower, like 4.4%, while the IRR is 15%.
So IRR really captures that project-like nature. Now, you hear a lot about manager selection being crucial in PE. Why?
Because there's a huge dispersion of returns between the best and worst managers. It's much wider than in public markets.
Not wide.
Top quartile managers consistently deliver IRRs above 20%, often significantly higher. Bottom quartile managers, though, they often see returns below 10%, sometimes even losing capital.
So picking any PE fund isn't enough.
Not at all. Accessing those top-tier managers is absolutely critical. It makes a massive difference to the outcome.
Okay, what about valuations?
Yeah.
Are PE firms paying high prices for companies?
Private company buyout multiples, usually measured as enterprise value to EBITDA, they vary. Depends on the size of the company, small cap, middle market, large cap.
Large caps are more expensive.
Typically, yes. Large cap multiples are generally higher. In global M&A activity overall, we saw sponsor-backed deals, those done by PE firms, increasing their share, made up 43% of deals in 1Q25.
So PE is a big driver of M&A.
A very big driver. For U.S. leveraged buyouts, LBOs, the purchase price multiples seem to have stabilized a bit recently, and debt is making up a larger portion of the deal financing compared to equity.
Let's talk about capital activity again, capital calls and distributions. You mentioned flows earlier.
Right. So the capital call rate is how quickly funds are drawing down that committed capital, the dry powder. As of 3Q24, for U.S. PE, it was about 13.8%. For venture capital VC, much higher at 26.2%.
Okay, so VC is deploying faster. What about money coming back? Distributions.
The distribution rates were 5.4% for PE and 18.1% for VC as of 3Q24. Both of those are below their historical averages. Meaning cash is being returned to investors more slowly than usual. Capital is tied up for longer. This impacts liquidity for the investors, the LPs.
But you mentioned IPOs rebounded a bit in 1Q25.
Yes, global and U.S. IPOs showed a significant rebound in deal value in 1Q25. Still below the recent peaks, but maybe a sign that exit route is opening up again.
Yeah, the secondary market, selling existing PE stakes.
That market is actually booming. Volume increased significantly. And pricing was strong. Secondary transactions happened at around 94% of net asset value NAV in 1Q25.
So strong demand even for existing stakes.
Definitely indicates strong underlying demand for private equity exposure.
What's driving the growth and innovation that PE often targets?
Well, fundamentally, U.S. business formations remain strong. Lots of new companies starting up.
Okay. Specific sectors.
Yeah.
Healthcare.
Healthcare is a big focus. One interesting dynamic is U.S. drug patent expirations. A lot of major drug patents are set to expire between 2025 and 2027.
Creating opportunities for generics, biosimilars, and M&A.
Exactly. Could spur significant global healthcare M&A as larger companies look to acquire new drug pipelines or technologies. And healthcare spending is just huge. The OECD average is over 9% of GDP.
And the elephant in the room? AI.
Artificial intelligence,
Yeah.
absolutely massive. Global private investment in AI has exploded. $471 billion invested just between 2013 and 2024.
Wow, mostly U.S.
Dominated by North America, yes. We're seeing huge venture capital investment in AI across pretty much all industries.
Any specific areas within AI?
Foundational models became a key new area in 2024, attracting $30 billion alone. And get this, AI-related companies now make up an astonishing 71% of U.S. VC equity investments in 2025.
71%. That's almost everything in VC now.
It shows a massive, rapid shift in focus for private capital towards AI's potential.
Okay, let's switch from private equity to its counterpart, private credit, PC.
Right. Think of this as lending directly to companies outside the public bond or loan markets.
And the main appeal here is yield.
Yield is definitely a major draw. Direct lending offers significantly higher yields compared to many public debt options, around 10.0% in April 2025.
Compare that to others.
Leveraged loans were around 8.0%, U.S. Treasuries, obviously much lower, 4.4%. Even U.S. high-yield bonds were lower at 7.7%.
So a clear yield advantage.
Right.
What about the spread, the extra yield over benchmarks?
Also significant, direct lending offered a spread of over 200 basis points, that's 2%, over leveraged loans, and nearly 570 basis points over the SOFR benchmark rate as of April 2025.
And the market itself is growing.
Rapidly. Global private credit deal activity has grown substantially. North America leads the way here, too.
Lots of capital flowing in, dry powder.
Huge amounts. Global private credit dry powder reached $585 billion in 2024. And fundraising has also shown really strong growth. There's a lot of investor appetite.
Okay, higher yield usually means higher risk. What does the risk profile look like? Default.
Interestingly, private credit default rates have historically been lower than default rates for broadly syndicated leveraged loans.
Really? Why is that?
Potentially more conservative underwriting, closer relationships with borrowers, tighter loan documentation, more control and restructuring if things go wrong. In 1Q25, the private credit default rate was 1.1%.
Compared to leveraged loans.
Which were 4.6% in 1Q25. A significant difference.
But are there pockets of stress? Commercial mortgages.
Yes, we do see stress there, mirroring the real estate picture. Delinquency rates in U.S. commercial mortgages are elevated, particularly for office properties.
How high for office?
Very high, 13.7% delinquent in April 2025. But again, bifurcation industrial delinquencies were very low, 1.1%.
Okay. What about payment in kind, or PIK income? Is that a worry?
PIK is where borrowers pay interest with more debt rather than cash. It can be a sign of stress. But recently, PIK as a percentage of income for business development companies, BDCs, which are big players in private credit, it actually decreased, down to 8.1% in 2024.
So that's a positive sign. Healthier borrowers paying cash.
Generally seen as a positive sign, yes. Less reliance on PIK suggests a healthier underlying environment. Other things to watch are amend and extend activity in loans and downgrade-upgrade ratios.
And can companies generally afford their interest payments? Interest coverage?
For U.S. leveraged loans, the interest coverage ratio EBITDA divided by interest expense was 2.7x in April 2025.
Meaning earnings were 2.7 times interest costs.
Okay. Generally indicates enough cushion, although it's something to monitor closely if rates stay high or earnings weaken.
And how does private credit relate to private equity?
Very closely. Direct lending is a major source of financing for private equity buyouts, LBOs. Private credit funds are providing an increasing share of the debt for these PE-backed deals. They often work hand in hand.
Got it. Okay, one final category to touch on, hedge funds.
Right. Often seen as the strategic edge in alternatives.
They seem complex, lots of different types.
Very diverse. Hedge funds aren't one single thing. There are many strategies. Equity hedge, which involves long and short stock positions. Relative value, looking for small pricing differences. Event-driven, betting on M&A or bankruptcies. Macro, making big-picture bets on economies or rates.
And returns vary a lot depending on the strategy.
Hugely. And also over time. The data shows wide dispersion, not just between strategies, but also between managers within the same strategy.
So manager selection is key here too.
Absolutely critical, just like in PE.
What's their main role in a portfolio then? Diversification.
Diversification is a big part of the appeal. Hedge funds, as a group, generally have a low correlation to a traditional 60-40 stock bond portfolio.
So they don't just follow the main markets.
Often no. They can even show periods of negative correlation, providing a truly independent source of returns, especially valuable during market turmoil.
How do they perform when markets get choppy?
A high volatility. Their performance tends to be more stable in different volatility environments, looking at the VIX index. Even when volatility spikes, hedge fund returns have historically held up better, generally speaking, compared to global equities, which can suffer sharp drawdowns.
Interesting. And any relationship with interest rates?
There has been, yes. Hedge fund excess returns, returns above a benchmark like Treasury bills, have shown a positive relationship with 3-month U.S. Treasury rates, especially in certain periods.
Meaning they can potentially do well when short-term rates are rising.
Potentially, yes. It depends on the strategy. But some strategies can benefit from higher rates or the volatility that often accompanies rate changes.
And we've certainly seen higher equity volatility since 2020.
We have, which makes that risk management aspect, that potential for smoother returns offered by hedge funds, even more valuable for some investors.
It really highlights their strategic role, doesn't it? Flexibility, dynamism.
Exactly. Navigating complex markets, offering something different from traditional long-only investments.
Wow. Okay, what a journey through the world of alternative investments. We've really covered a lot of ground.
We have, from the foundations to the specifics.
We peeled back the layers, started with the shifting sands of that traditional 60-40 portfolio, and then dove into this dynamic landscape of alternatives. We saw how real estate offers that potential diversification and inflation hedging, but with really varied performance across types.
Yeah.
You know, the struggling office market versus booming industrial and data centers.
Very clear split there. And we explored private equity, noting how companies are staying private longer, changing where that value creation happens. We looked at the fundraising and exit dynamics, which are definitely evolving.
And that strong focus on high-growth areas like AI and healthcare and PE.
Can't ignore those. Then, private credit, its attractive yield advantage, its historical stability compared to some other debt, and its growing role financing the private economy.
And finally, that strategic edge with hedge funds, offering diversification, risk management, especially vital in today's, let's face it, pretty volatile environment.
Absolutely.
So ultimately, understanding these alternatives, it really gives you, the listener, a much more holistic view of the investment opportunities out there. It expands the toolkit beyond the traditional.
Which is crucial in today's dynamic market. It's about being informed, adaptable.
So the final thought then. What does this all mean for your understanding of future investment frontiers?
Yeah, that's the key question. As technology, particularly AI, continues to accelerate its influence across literally every industry, how might these alternative strategies evolve further?
Right. What new opportunities or maybe new challenges could that present for investors like you seeking to diversify and enhance your portfolios in the years ahead? Something to think about.